Hello, this is Jordan, and this video is being recorded on the evening of December 6, 2020. And in this video, I'm going to discuss when or what is going to cause the next downturn in the stock market, and later on, what that will eventually mean for precious metals. Thank you so much for tuning in. Be sure to subscribe to the channel if you already haven't, and let's get into it. So I have three charts that I'm going to be looking at various things in these charts. And here we have the CPI, which is a measure of inflation at the top, the 10-year bond yield in the middle, and then at the bottom we have the S&P 500. And the best comparison to today is the 1960s. And it's something we haven't seen for decades. Literally, I mean, at this point, you have to go back over 40 years where rising inflation can cause, well, not necessarily a crash, but a severe bear market in stocks. And given how we're setting up, I think that is going to cause the next downturn in the stock market. I don't know if it's going to be in a year, a couple years, but that's what I firmly believe. And if we go back to the 1960s, really, things really began to change macro-wise. You go back to 1964 or 1965, that's when inflation started to tick higher. You had the CPI, which had, it had about a 6 or 7 year breakout there, something like that in 1965 when it started ticking higher because it wasn't doing anything before that. And then it was eventually the very end of 1967. That's when you had a big breakout in the CPI, where it climbed above 4%. It eventually, over the next year or two, I think got up to 6%. So that breakout in late 1967, that was a 15-year breakout. So that was really significant. And of course, as inflation went higher, so did long-term bond yields, as shown by the 10-year yield there. But the key scenario with stocks is, as you can see, if you look at the three bear markets that happened after inflation started ticking higher in 1965, you can see that those were caused by the higher inflation and the higher bond yields, because you can see those three lines connecting the lows in the stock market in 1966, 1970, 1974. I mean, those lows basically coincided with peaks in the 10-year yield, so peaks in long-term interest rates. So inflation went higher, bond yields, interest rates went higher, and as they started moving higher, that was bad for the economy, bad for the stock market. So the stock market sold off, went into a bear market, and eventually, when inflation receded, interest rates went lower, and stocks rallied again. But another key takeaway here is, well, I'll get into this towards the end, but you can see that just from the mid-60s to the mid to late 70s, I mean, the S&P, it didn't do anything in nominal terms, so it was getting killed in real terms. So, but remember, in an inflationary environment, you can see here stocks and bonds are positively correlated. Interest rates going higher, that means bonds going lower. So in an inflationary environment, stocks and bonds tend to be positively correlated. And that's what you saw in the 60s and 70s. So the question is, okay, when might that happen? When is the 1965 or the 1967 type breakout for inflation at the present time? And you can see at the top there I have the CPI. I did put in the middle, I put the CAPE, the 10-year PE ratio, because that's also significant. But getting back to the CPI and inflation, it's been trending down for 30 years, basically. You can see that I've connected 1, 2, 3, 4 peaks there from the 1990 peak to where we are now. And so if we see the CPI get to 3% or get above 4 or get to 4%, that's going to be really significant. I mean, that's a significant breakout of the downtrend. That's going to be negative for stocks. And another thing with regard to valuations, you can see, I mean, look what happened in late 1967. You can see that line, valuations went down. So stocks do really well in a disinflationary environment. So as long as the secular trend for inflation is trending down, that is very bullish for stocks because that leads to higher valuations. Lower inflation leads to higher valuations. Higher inflation is very bad because it leads to lower valuations. You can see what happened after 1967. The CAPE went down until 1982, one of the greatest buying opportunities ever in U.S. stocks. So this is the important takeaway, is watch the CPI, because if we see that break that blue trend line, that is going to be a signal that inflation has broken out and is likely to start to run. And at that point, that will negatively impact the stock market. So last thing, I have gold in the title to this video. I should probably talk about that. In this chart, I have the 10-year yield at the top, gold stocks, the Barron's Gold Mining Index in the middle, S&P at the bottom. And gold stocks, they tended to be somewhat positively correlated to the stock market until there was a period, I want to say late, the middle of 1972 through about 1978 or 79. No, through 1978. That is when the gold stocks and gold were negatively correlated to the S&P 500. So I don't know if they're going to become negatively correlated in the next year or two. It's going to depend on that breakout in the CPI and inflation. But at some point over the years ahead, they will become negatively correlated to the stock market. So that's the important takeaway for gold and gold stocks. But the main takeaway of this video is that the CPI and inflation, when we see the breakout there, that 30-year downtrend break to the upside, that is going to be a real important signal of inflation really taking hold, maybe even accelerating. And that is when you get bad performance from the stock market. And you can see there, look what happened at the bottom there, the S&P 500. You can see the horizontal line from 1967 to 1979 or even 1980 before it rebounded. That's in nominal terms. The stock market went nowhere. That's more than 10 years went nowhere in nominal terms. And that's with inflation really taking off. And of course, during that period, the gold stocks did really, really well. And that's something that I expect over the next 5 or 10 years. I mean, it's going to be volatile. There will be bear markets, but that's my guess, is over the next 5, 10 years, you're not going to see good performance from the stock market, but you will see really good performance from precious metals and probably commodities as well. So that's all for this video. You can follow all my work at The Daily Gold. Thank you so much for tuning in. Check out thedailygold.com, thedailygold.com/premium. And also be sure to subscribe to my YouTube channel here. I really appreciate it. Thank you, and I look forward to doing another video for you guys in the days and weeks ahead.